Welcome to The Explainer. I am absolutely thrilled you're joining us today because, well, we've got a truly compelling financial mystery on our hands. We're going to be unpacking the current valuation of Texas Capital Bank shares, or TCBI for short. When you look at the market, you usually see companies falling neatly into one of two camps. They're either high-flying momentum stocks, or they're these quiet, fundamentally sound value plays. But it is incredibly rare to find a stock that literally forces you to aggressively question which category it actually belongs in. So today, we're putting on our financial detective hats. We're going to act like sell-side equity analysts, digging deep into fundamental valuation, using the raw data to see if TCBI's explosive momentum is actually justified by its underlying intrinsic value.
And I want to kick things off right here. 318.58%. Yeah, that is Texas Capital Bank shares trailing 12-month net income growth. Just let that massive number sink in for a second. We aren't talking about some tiny, scrappy tech startup here. We're looking at a deeply established financial institution that has literally tripled its net income over the last year. This staggering figure right here, this is the engine driving our entire conversation today.
All right, so let's quickly map out our agenda. First up, we'll examine the TCBI growth explosion. Second, we're going to assess their financial health. Third, we'll decode the valuation multiples. And finally, we'll confront what I'm calling the fair value disconnect.
Okay, let's jump right into Section 1, the TCBI growth explosion.
So looking at the return metrics over multiple timeframes, it brilliantly illustrates some incredibly strong momentum. We aren't just looking at a short-term blip on the radar. The year-to-date return is sitting at a very healthy 11.2%. But if you zoom out to the trailing 12 months, you're looking at nearly 43%. And if we zoom out even further to the 3-year mark, the stock has returned a whopping 108.23%. What this tells us is that the short-term momentum is backed by a massive, multi-year upward trend. When we smooth those numbers out, we get a 57.58% total return compound annual growth rate over the trailing 12 months. I mean, that is absolute proof of explosive pricing action. Investors holding TCBI over the last year have been rewarded handsomely, for sure. But as focused analysts, we know the golden rule, right? Past price action doesn't automatically guarantee future results. Which brings us to the million-dollar question. Momentum is surging, but what is actually under the hood? Price appreciation is fantastic, obviously, but if it's outpacing the actual fundamental business operations, well, you end up with a dangerous bubble. We really need to know if the underlying fundamentals actually support this rapid rise before we get too carried away.
So let's shift gears and dig into Section 2, assessing financial health.
Here's a quick snapshot of their core engine. The net profit margin is sitting at a very solid 11.57%. And get this, that's actually up over 45% compared to their trailing 12-month average. They're generating a 9.42% return on equity and a 1.04 return on assets. But honestly, perhaps the most comforting metric for anyone looking at fundamental valuation is that bottom one, a debt-to-equity ratio of just 0.24. That indicates highly conservative leverage. Basically, they're generating strong profits without drowning their balance sheet in debt.
Now, if we really want to gauge financial health, we have to look at the cash, specifically free cash flow yield. Just to cut through the financial jargon for a second, this metric simply tells us how much actual, cold hard cash the business generates relative to its current market valuation. It's an absolutely fantastic way to strip away the accounting noise and see the real cash a company is producing for its owners.
And for TCBI, the free cash flow yield is a towering 9.79%, which easily beats out its earnings yield of 7.64%. Now, why does this matter? Well, because a free cash flow yield getting close to 10% is incredibly robust. In fact, to put that into perspective, that 9.79% is up over 16% compared to their historical 3-year average. So they aren't just showing accounting profits on paper, they are printing actual cash.
Let's move on and see how this builds into Section 3. Decoding the valuation multiples. Comparing today's price tags to the 3-year historical averages, the price-to-sales ratio is at 2.21 and the price-to-book ratio is 1.22. Now, both of these are up slightly from their 3-year averages, which honestly makes perfect sense given the stock price has literally doubled in that same time frame. But the price-to-earnings ratio tells a completely different and pretty fascinating story. Focusing specifically on the current PE ratio, it's sitting at just 13.53.
As you likely know, the PE ratio is kind of the gold standard metric for equity valuation. It tells you exactly how much you're paying for $1 of the company's earnings. And a PE of 13.53, that's generally considered quite reasonable, maybe even cheap, especially in today's broader market.
Now, what's really interesting about this slide is the historical context. That 13.53 PE represents a massive 69% drop from their 3-year historical average PE, which was way up at 44.32. Think about the math here for a second. The stock price went up over 100% in 3 years, yet the PE ratio actually compressed by 69%. How is that even possible? Well, it circles right back to the very beginning of our investigation. Net income grew by over 318%. The company's earnings exploded so violently upward that they actually outpaced the soaring stock price, and that drove the valuation multiple way down.
Which brings us to our final segment, Section 4, the fair value disconnect.
So, the earnings support the price, right? Well, actually, scratch that, not so fast. Here is the core tension of this entire explainer. Despite the incredible health, the low debt, the surge in cash flow, and that massive earnings growth we just talked about, standard fundamental models peg the estimated fair value of TCBI at just $78.22. Meanwhile, the stock recently closed at $100.68. So the crucial point we have to reckon with is this. Buying right now means accepting a negative 28.71% margin of safety based on aggregate fair value estimates. Essentially, standard earnings-based valuation models suggest the stock is currently trading at a hefty premium. The market is paying up for that momentum and growth we saw earlier, and it's pushing the price well above the historical baseline of intrinsic value.
However, as rigorous financial analysts, we really have to look at all the evidence. There's a vital data nuance here. If we abandon the earnings models and look strictly at a free cash flow discounted model, the estimated fair value absolutely skyrockets to an incredibly optimistic $383.07. Now, we definitely have to treat that as an extreme outlier, but it proves exactly why that 9.79% free cash flow yield we discussed earlier is so darn important. The cash generation is just so strong right now that cash-based models see almost unlimited upside, even while the traditional earnings-based models are flashing warning signs.
Which leaves us right here with this final thought. Is the momentum actually worth the premium? We've seen the 300+% net income growth, the incredibly low PE ratio relative to its history, and that rock-solid balance sheet. But we also clearly see that at over $100 a share, you are paying a 28% premium over standard fair value estimates. So, are TCJBI's fundamentals and cash printing capabilities strong enough to justify paying that premium today? That's the ultimate question you have to answer. Thank you so much for joining me for this explainer. Keep digging into the data, and I'll catch you next time.